Hey, everybody, it's Pete Carmasino here at Chaikin Analytics. Thanks for tuning in to this week's halftime show here on StockCharts TV. We appreciate all of your feedback. So after this video, go check it out on YouTube. Put some comments in there, some likes. We really appreciate that. But, week to week, we've been looking at the ACP platform, looking at the Power Gauge plug-in that is available on that. And it's important. But I really think the current levels of the markets and what's actually happening right now in the markets, as far as index levels, pace of change, you're seeing a rate of change in rates move today, are really kind of pressing. And so I kind of want to just keep that theme of the overall market and just look at a few charts that I've showed some of our members in the last couple of weeks and even today. So I'm putting this out to you guys here today after our subscribers got it. And I just want to kind of look at, again, certain levels. We're looking at bullish percent levels in the New York Composite, the S&P, the NASDAQ, and kind of the week-to-week changes that have been kind of identifying the downtrend. And then obviously some levels on the S&P that we were targeting were hit today, really to the penny. And so we just want to kind of show what we are capable of here at Chaikin and what our research is showing us in the markets. So let's go take a look. Okay, week to week, I kind of put this chart out, and today's chart is showing nothing new. The rallies we're only two into it, into this bear, according to my calculations. And just looking at the bullish percent down here, you've got the New York Stock Exchange, the NASDAQ Composite, and the S&P, right? And these panels below the chart of the S&P itself. So when I'm looking at the bullish percent, you're seeing decreasing levels, and it's been decreasing for months. It's not something new. The divergence was the index wasn't. And so that meant that only a small portion of the index was pushing the index price higher. But the bullish percent, the tide, as I like to call it, the riptide that you cannot see below the surface, was changing trend. Now we're seeing that trend continue. And when the rallies move higher, you see it increase. And obviously at a certain point, it starts to roll over. And that's where we're getting the sell-offs, right? Sentiment has been week to week has been changing. You've seen the bears take over, followed by June 1st. We saw a weekly sort of leveling of bulls to bears and neutrals. And then obviously last week we saw more bears. And West Texas crude and oil in general and natural gas have been trending higher. We've been talking about that. And we were building these range boxes for months. And all I did was basically duplicate the levels and push them higher. And each time we get into the next range, we kind of live in that range for a little bit and then move higher. And that's kind of how oil trades. I mean, oil's off a little bit today due to some news out of China, potentially locking down and not reopening as fast as they thought, or just increasing some restrictions. So that's pushing natural gas and oil down today. But there's no doubt there's some demand destruction, but not much, really. I think people are up and out and traveling. And so you're not seeing that big demand that we thought was going to come from China right away, but you're not seeing demand destruction. So oil and natural gas are kind of leveling out here. When you look at these charts, it kind of shows you where natural gas has been, where it's going, where it hit on Friday at 966. That's pretty amazing. We haven't seen those highs in a long time. And target of 15 is on the table. And we look at what we're paying versus what the rest of the world's paying, we look cheap. And that's scary because last year, the European average price was around 9, and it hit as high as 60, and currently trading in the 40s. Sometimes it's ranging between 28 to 35 and as high as 40. So you're seeing these spikes in demand happen a lot across Europe. And the natural gas fund had just continued to break out. Here's the 25th. There's May 12th. And there it is today at around 29 change. It probably changed a little bit today, but that's kind of been the trend. It's been higher. And you start to look at rates. We were calling for 275 and 3. That hit in April. And then May 3rd, we put a note out. You can pause the video and kind of try to read this here. I'll give you a second to at least have a frame that you can pause. And then move on to May 10th. We started talking about 3.5 to 375. We hit 335 today. I mean, we are running hot on the interest rates. There was the quote from CNBC this morning. And what does that mean? That means bond funds are moving lower, seeing TLT being overbought in some cases. That's just part of a downtrend. It'll move down, get overbought, move lower again, get overbought, and the trend just continues and continues. And today it hit a low of 109.78, which was just trading at 113 on Friday, 114 on Friday. So you're seeing this push lower and lower, and that's pushing rates higher. We have a $100 target price on it and have had that price, for quite some time. So looking at what's happening here in bonds, it's no surprise to us. We've been calling this since October, November, and specifically in December, saying you should avoid bonds as best you possibly can. The S&P, we had a head and shoulders chart we built. We had a target of 3750. Then we put a new target of 3420 because 38 was hit. And what happened? Traded right back to that 4100 level that we've been calling out as sort of our make or break level, 410 on the SPY to be exact. But finding a new level of 3420 by using a different neckline has kind of pushed us into some lower lows, obviously. But what did we see this morning? We saw the rollover from 4100 all the way down to 3777 and actually hit 3750 on the nose today before bouncing higher. So we're off our worst levels today. But again, a downtrend nonetheless in the market. I mean, that's kind of what we're seeing play out. 375 target was hit. This is where it was just on the other day when in this particular box when we saw the range kind of sit sideways around resistance. And we knew it was overbought. We wanted to avoid it. And obviously we called that out for many days in a row. Again, looking at targets, 375, 380 has been on the docket since May 23rd. Look at the June 10th chart. Kind of same situation, 340 being a much lower level. There's that chart again. I repeated it, but that's kind of what's happening. This says 6.6, but that's actually today's chart. I apologize for that. That's a miscalculation there. Point is, we hit our ranges, resistance held, and we rolled over. That's really the story of all the indexes today. All trending lower. 250 could be on the table, obviously dependent upon the big positions, the big weightings in these indexes. If they continue lower, we're going to see. Now, Apple hit a low of, I think, of around 132, 133 today, and currently trading, I'm just pulling it up on a different system here, at 134 and change. So off its worst levels, definitely an oversold bounce. But that put in, it looks to be a new low. I can't tell for sure. I'll have to double check that before we end. But Q's here just kind of rolling over again into that 275 area, 280 range. This one has been really incredible. A huge range for about a year. Broke down. We called the 188 level resistance. It definitely held up in the last couple of days. And now we're below the 175 level, currently trading at 172 and change, down 3.5%, down $6 and change. And so when we get below that 175 level, if 175 becomes resistance, we can see lower lows here as well into the 155 to 160 range. So something to be aware of. You look at the Dow Jones Industrials on the 9th, same box formed. You had an overbought setup, and now you're seeing the Dow Jones today just roll over everything. Again, nowhere to hide in today's market. And again, it's just a continuation of the trends. I mean, it is what it is, and it's important to kind of understand where things can go and what can happen. And that's why you want to, again, use your risk management strategies and really try to protect your downside. If I look through these point and figure charts between April 29th to the 12th to the 19th, you're just seeing a continuation of these trends. Here we are today, and I don't know if that's going to put in a new box on this point and figure, but let me just double check where we are. The low was 305. Yeah, I think it's going to show a new box. No, it needed 304 for a new box, so it probably didn't. So the low being 305, spot 39 right now. And anything below that will probably put it in a new box, and we'll be heading to those unfortunate levels on the Dow. And again, remember, even at 3420 on the S&P, that's a 29% down drawdown. And typically bear markets are 33 to 35, as high as 50 in some cases. Let's hope that changes this time, but we'll see. And the semiconductors have obviously been in a range-bound downward trend move, right? As it gets overbought, it's sold. Gets overbought, it's sold. Gets overbought, it's sold again. This was the chart on the 9th, and here we are today from about a 240 level to about 215. Low on the day was 211.28 on the day. Okay, so we want to be careful in these markets and use our risk management resources as best we can. Hey, I just want to remind you, I'm on Twitter. You can follow me at Pete Carmasino. I post out some charts here. We kind of let people know while this is happening. About 4 or 5 hours ago, we talked about this level, but we were shown it back in May 23rd. So again, not something new here, but we try to communicate on all different levels, obviously. So if you want to follow me on Twitter, we put out some things here and there that you might be interested in. But looking back at some of our letters here, the letter that I wrote on the 17th, and really on the 3rd, calling out levels of 350 to 375 on the 10-year, and that's really what's important here, because when you start to understand the trends and where things are going, it's a natural transition. I mean, bonds are going to sell off, right, when rates go higher. And actually, let me rephrase that. Bonds selling off create the move higher in rates, not the other way around, but the narrative has already been higher rates. So it's not going to be a surprise that bonds are not, quote unquote, holding up and becoming the safe haven. Now, they do have moments of greatness here, and that's been overshadowed by the big downtrend, but you're going to see it get oversold, bounce higher. People will call it a risk off trade or a rush to safety. But today, we're not seeing that. Right, we saw a low, as I said, 109 in TLT. That's not a flight to quality. Now, maybe on the lower levels, the yield curve, you're seeing it. But if I pull up IEI, which is a much shorter term duration, that hit 117. That's the last 3 days. It was as high as 121 just a few days ago, and now it's a low of 117. So you're seeing it at all levels of duration where bonds are kind of selling off. And so we were talking about the range here. Obviously, it's going to be more detrimental to fixed income assets, but don't forget, it also affects technology. Technology is a long-dated asset. When rates rise, it discounts their future earnings, and so on and so forth. And so that's where a lot of this is coming from. When you start to understand the dynamics of what's happening out there in the market, you can see here's SMH that hit a low today. I can pull up my one-day chart here internally on this. Again, I said 211 spot 28. That's the low, and really has recovered off its worst levels, but not something that's dramatically changing here. And even if I look at IEF, right, if I look at the 7 to 10-year range, just a few days ago, trading in the 102s, that has cracked 100 today. It's at 99 spot 31. That's where it's trading, and that's what's happening, right? The fixed income market is under pressure. Rates are moving higher. We got the FOMC meeting this week, and so that's really what's going on. Just some other things on the ACP platform that I like to look at are the bullish percent levels. Now, I called this out. We talked about it early in the first chart where you can see that's been declining. When you look here, I built just some levels. When it's at 70, it's in the red zone, and obviously when it's at 30, it's in the green zone. And so when we move rapidly higher, when we move from a low of 25, 24% on the New York Composite up to 50, that's more than a double. And that rapid pace higher is typically followed, not always, but typically followed by a rapid decline. And that's kind of the setup that we saw. We were worried about being oversold here. There could have been an area of, okay, let's wait if we're going to liquidate anything and try to liquidate into rallies. That's really what's been going on here. And so it's been a sell the rally on the indexes and a buy the dip on the commodity energy sector. So that's the dynamic that's playing out right here in the markets. All right, everybody, that's all we have for today. Again, I hope you're using your risk management your risk management tools, I should say, and making sure that you're managing yourself on the downside. I mean, it's very hard to do. Professionals are having trouble with it as well. But as I noted, even some hedge funds are going market neutral in some of their positions. And so when that's happening, you're going to get whipsaws in the market, but we just continue to hit lower lows, and that's really important to kind of pay attention to. Thanks again for tuning in, and we'll talk real soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.